are with Breakfast. Thank you for your company. Sometimes things happen that are so big, those of us who think we understand them can't actually explain them, and those of us who don't understand them aren't even really sure what questions to ask. It felt a little like that last week when the government announced its $50 billion COVID-19 recovery fund using borrowed money. And of course, the Reserve Bank told us it's going to buy billions of dollars in government bonds. So if the Reserve Bank is lending the government money, where does their money come from? Why is the Reserve Bank doing this now? Who decides this happens? And where does the money go when it's repaid? If you haven't a clue, join the club. That's why we're doing this interview. It's with great pleasure we bring in an expert, and not just any expert. Yuong Ha is the chief economist and the head of economics at the Reserve Bank. Yuong, it's so nice to have you with us and your expertise. Thank you for joining us. We had a chat yesterday. I said, Yuong, I want this to be a real 101 into how the hell this works so that people know. And I want to start with the phrase quantitative easing, because I think the moment people hear that phrase, they just button off. Is that the same as printing money?
Well, the process is very similar, but I think rather than being bedazzled by the term quantitative easing, us economists love throwing around these fancy terms. It might actually help if I can sort of set the scene a bit better for you. So I think the name of the game is still the same. We want to lower interest rates. The economy is going through taking a big hit right now. It needs all the support it can get. And the central bank can provide that support by pushing interest rates low and keeping them low. Right. So what we've got to do is find different ways of getting interest rates down. And quantitative easing is a fancy name. You probably would have heard the OCR. That was a more traditional way of doing monetary policy, but we're now using quantitative easing. I think a good analogy would be the OCR is like 10-man rugby, very traditional, very well understood. Quantitative easing is us spinning it out the back line.
Nicely put. Yeah. But are you printing money, Yuong? Are you somewhere? Are you out the back with the printer?
Metaphorically, we are. I mean, that's one of our special powers. Central banks can print money or create money. These days it's done electronically. We're in a digital world. It's not analog. We're not physically up there cranking the handles and money coming out. But again, if I can sort of use a very simple analogy, there are retail interest rates in the economy. Your mortgage rates, for example, they're the most obvious example that people can relate to. They are set at a margin above wholesale interest rates. You know, in much the same way if you and I were walking to a shop and to buy an item, we'd pay the retail price.
Yeah.
But that retail price would actually be set at a markup over its wholesale price, right? So what we're trying to do with quantitative easing essentially is to lower wholesale interest rates in the economy, in this case, government bond rates. So if we can pull the wholesale rates down, banks can then pass on those cost savings to customers in the form of lower interest rates, lower mortgage rates for households and businesses.
And I think people understand that cause and effect much more, and the OCR, so that if interest rates are low, the cost of money is low, which means we borrow more and spend more, and that stimulates the economy. But can I come back to my obsession with, and we're talking metaphorically, you're obviously not printing real money, but you are creating money. Who gives you the right to do that? Who says you can?
Well, the government does. I mean, it's our superpower, if you like. The legislation says that the central bank, all central banks have that superpower to create money, just like the government itself has its own powers to be able to levy taxes and change taxes. So central banks have that unique feature of being able to create money. And
so if you create, for argument's sake, $50 billion extra and you buy government bonds, so therefore the government is borrowing the money from you, when eventually at some stage in the future the government repays you, what happens to the money?
It gets unprinted, if you like. So just like us creating money as a few keystrokes on an electronic ledger, that suddenly money turns up. When that money gets repaid, it sits on the Reserve Bank's balance sheet, and we just metaphorically destroy it by undoing it with a few keystrokes. So it just works in the reverse. So
when we don't need it, when we don't need quantitative easing, when the economy's singing along,
that's right.
That money just, you unprint it, it ceases to exist.
Exactly.
Yeah. Yep. Boy, you can see how people get confused by this, can't you?
Yeah, I think people get confused by the quantity. I mean, I'd say just focus on the fact that interest rates are low and are going to stay low, and the idea is to keep interest rates low to stimulate the economy. How we do that? Well, it feels arcane, but there's nothing untoward about it. It's what central banks do on a daily basis, and we have done for many years, decades even. It's just that all of a sudden we're doing it in much larger quantities. It grabs all the headlines. It's kind of like finding out that you can suddenly lift the line-out jumper. Really, this has been going on for ages. It's just, to the uninitiated, it feels astounding. But central banks have been in the business of creating and uncreating money, destroying money. And we're doing that to basically influence the level of interest rates in the economy, primarily at the wholesale level. The idea that if we can lower wholesale rates, banks can then pass on those cost savings, those lower interest rates, to the retail customers through lower mortgage rates and lower lending rates for businesses.
Yuong, I think many of us will feel like we know a little bit more than we did sort of 6 or 7 minutes ago. So we so appreciate you joining us today. You're fantastic at explaining this. I love all the rugby analogies. We might actually begin a series where you come on and explain complex economics in ways we can all understand. Thank you for your time. It's absolutely fascinating. And we should say that the Reserve Bank is independent of government, and that independence is enshrined in legislation. But that doesn't mean that you can't work with government, which is a separate thing, right?
Exactly.
Right.
Yep. We are coordinating. That's right.
Yeah. Thanks, Yuong. Really good to talk to you. Yuong Ha, who is the head of economics at the Reserve Bank.
I feel smarter.
Yeah.
Yuong's awesome.
That's a skill, isn't it, to explain something like that?
if I can get some of that money, I haven't quite worked out that bit yet, but whole printing, unprinting, we could...
The big thing I got out of that, keep the interest rates low, so it helps stimulate the economy. But the funniest thing was, I was in the control room watching you. You were like a pig in mud.
Yeah, I love that. I love talking about that stuff.
Yeah.
And I democracies function better when we know how governments are working.
Yeah, and I knew the term quantitative easing, and I understood the concept of low interest rates. I just hadn't tied the whole thing together in a rugby analogy.
Yeah.
It works.
Numbers in rugby. There you go.
Making news this morning, the COVID